I'd like to turn it over to Asa, who will introduce Redstone and himself.
All right, thank you, Donna. So our firm, Redstone Government Consulting, we're a non-traditional consulting firm. We're focused solely on government contract, business systems, costs, and audit issues. I like to tell folks that we're not a CPA firm, but we do employ a number of recovering CPAs. All of our staff are either retired government contract industry veterans from areas like contracts, accounting, finance, program controls, or they're retired from government agencies like the DCAA and DCMA. And our client base really spans all over the world. We work with contractors of all shapes and sizes. And we focus on providing preventative, ongoing, or as-needed solutions when problems arise with their work with the U.S. government. I like to tell people that government contracting is not hard, but there is a steep learning curve, and that's where we add a lot of practical value to our clients' team by providing both past experience from industry or from the agencies we've worked with in our prior careers, and also real-time experience through our work with contractors all over the world undergoing audits and various other inquiries under their government contracts. So I find it's often easier just to cover a little bit of what's on my desk by way of an introduction to what we do. At the moment, I'm working with a very cool startup in Palo Alto that was recently awarded their first government contract and just helping them wade through all the fun that comes along with that first contract award. I'm working on an indirect rate restructuring project for a large publicly traded company, and I'm also assisting another company with some contract negotiations pertaining to a commercial vaccine supply contract that they're doing with NIH. And personally, I'm raising bees and chickens, and I have a little mini farm, and I'm waiting on my wife to finish tax season. She's a CPA, and so she's up to her eyeballs in tax returns. As far as ICS goes, we've got several in the beginning stages that are coming in. And I've been preparing and reviewing submissions, incurred cost submissions, for a little over a decade, and we work with clients in a lot of different ways. We do full preparation, we do reviews, and we also, for our small businesses, we have a kind of a fixed price monthly service where we're an on-call resource to their staff and do an adequacy review right before they submit the submission. So that's a little bit about me. Donna, I'll turn it back over to you.
Okay, thank you, Asa. So Unanet is a software company. We're a leading provider of cloud and on-premise software for project-based organizations, and we are headquartered in Dulles, Virginia. We provide a purpose-built project ERP solution that includes the capabilities of skills management, resource planning, budgeting and forecasting, time and expense reporting, billing and revenue recognition, project management, analytics, dashboards, KPIs, and of course the integrated financials components with AR, APGL, indirect rates, and cost pool calculations. We have over 1,000 customers today who trust Unanet to help them run their businesses. And we help organizations maximize their utilization of their staff, reduce administrative costs significantly, up to 90% so far, and we improve invoicing and the invoicing process by up to 10 times. And we support forward decision making for improved operations. So you're going to see a little bits and pieces of that today. Okay, Asa.
So last year, Donna and her folks, they were kind enough to invite me over, and we did a webinar on the incurred cost submission where we covered the ICE model itself that DCAA provides, the incurred cost electronic model. And Jim Morrison from the Unanet team went through a lot of the great reporting that Unanet offers for facilitating the population of the schedules. And the link to that webinar is there on this slide, and you should have this in your handouts as well. But this year, we're really focused more on step 2, which is what happens after you submit your incurred cost submission. But just to catch everyone up, we'll do a couple slides on what the ICS is and why we have to prepare it. Then we'll take a look at the next step in the process, which is the DCAA adequacy review. And we won't have time to go through the entire adequacy checklist today. We've just got an hour, but I'm going to kind of go through our top 3 things that we see with that process. And then we'll move into the process that DCAA uses to select contractor submissions for audit. There's a little secret here that not everyone gets audited every year. In fact, many do not. So this is a good way to kind of gauge your risk. And then finally, we're going to walk through some recent trends that we're seeing in our interactions with DCAA auditors at new and existing clients on active engagements. And we're going to also share a little bit of information that we've gleaned from some of DCAA's memorandums to regional directors, annual report to Congress, some case law, and the 27 NDAA. So we've got a lot of information to cover. We're going to cover it at a very summary level, but we're happy to take questions as we go along throughout the webinar. All right. So when I talk to a new client about their incurred cost submission, the very first question that I have is, what accounting system are you using? And I'll say that having prepared incurred cost submissions for contractors using everything from QuickBooks to SAP, that not all systems are created equal. When you boil it down, your accounting system is really nothing more than a toolbox. You should have lots of tools in there to make your life as a contractor working for the federal government easier. The tools are unique to the system, though, and not all systems out there are designed for government contracting. And some of the contractors that we have the most trouble with are using a lot of the more commercial solutions where they have a lot of great tools, but they have to be customized or tweaked in order to get them to work the way that a government contractor needs. And on the opposite end, solutions like QuickBooks exist, and QuickBooks can be great, but it also can be a bad thing because it will really let you do almost anything within QuickBooks. So it's missing some of the controls that you need. Solutions like Unanet provide the tools you need to survive, but they're also designed in a scalable way to work with companies of all sizes. So you can run the system with a staff of 1 or a staff of 20, and it gives you the tools you need. The most important tool in the toolbox, though, is you guys listening in today. You are the key to success between your company and the government auditors. And the best designed system in the world will not overcome bad practices and lack of procedures. So you guys are the gatekeepers, and we're glad to have you here today.
Okay, and with that, we thought we would launch a poll to ask all of you out there on the webinar today, and there are a lot of you. What is your current accounting software? What do you use today? So if you could go ahead and quickly select from these options. And we've got a good number of people answering, and we'll let it run for another few seconds here. Okay, all right, well, let's go ahead and stop the poll, and let's share some results with the group today. So it looks like we have about 45% of you on the call today who have answered are using Unanet. That's great. Large percentage using QuickBooks. So I'm sure a lot of you will find this particularly helpful on how we can make your life simpler with preparing the incurred cost. GCS 8%, Delta Cost 0.5, and other solutions. 12% of you who answered are using those. So thank you very much. That gives us a good idea on what you're using today, and Asa and I will kind of gear that to, or use these results to gear the rest of our presentation. Thank you. Okay, Asa?
So for me, when I think about the incurred cost submission, I think about it a lot in terms of the tax return. And that's usually what I tell people when I'm teaching on the ICS, because that's something we can all kind of latch onto. So if you're familiar with incurred cost submission, you probably know that Schedule I, that's kind of the heart of the submission. That's the schedule where we present our cumulative claim costs, and then we compare that to what we billed to determine the over-under billing. And that's the overall purpose of the incurred cost submission. The process that we go to get to this point is a lot like what happens for most of us with our own personal tax returns. Your 1040 is a pretty fitting analogy this time of year with April 15 coming up. And in the case of your tax return, we let HR or the payroll folks know what we estimate our taxes will be based on our dependents, wages, and all these other factors that come into play. And this is a lot like filing our provisional or forward pricing rates to let the government know what our estimated indirect rates will be. In both of these steps, they happen at the beginning of a fiscal year. And then next in the process, in terms of the tax return, payroll does our withholdings on our paychecks. And in terms of the ICS, we submit our invoices with those approved estimated provisional rates. And then at year end, whether the tax return or ICS, we have to true everything up. And we do that through our 1040 for our tax return, but we do that through the ICS for our indirect rates. And so that's kind of the whole purpose. We're trying to true up our indirect rates to actual via this submission, determine if the government owes us money or if we owe money back to the government, just like when you do your 1040. The main difference for me, though, is that the ICS is a much bigger pain to deal with. There's not really a TurboTax for the ICS, and that's why people like me, have jobs and amongst other things. And I will say that Unanet's getting pretty darn close to being able to produce a lot of the standard reports and information that you need to populate the submission. So, Donna, would you care to comment on some of these features that Unanet has to make things a little easier?
Sure. Thank you, Asa. So yes, Unanet does help a government contractor's life, making it simpler when it comes to completing the ICE workbook anyway. So for a few things that I'll point out and how it helps. Number one, Unanet is a single solution. It's one database, one system for managing people, projects, and financials. And the benefit of having a single solution, and there are many, versus separate modules or separate components for project accounting and financial accounting is that the project financial information is always reconciled to the general ledger after labor and expense posting. So there's really only one set of data, so reconciliation becomes unnecessary, which is a big time saver for customers. And beyond that, there is traceability of a transaction from all the way through, from timesheets through project accounting through your general ledger in one single solution, so you're not matching up actions among different modules. And also, inside Unanet, there are a robust set of project reports, including many that share project cost information at the project, task, CLIN, SLIN, and frankly, any funding level required based on how you set up the system. Time and materials, cost plus, fixed price contracts are supported in Unanet. So these reports in Unanet are used along with the Unanet General Ledger Summary or Trial Balance Report in a process, a Unanet developed process to generate the schedules. It requires, both the financial and the project data that the ICE schedules and the workbook require. And finally, as Asa mentioned, and we'll describe a little bit later, there's a lot of attention today on subcontractors with respect to monitoring their progress and performance. And Unanet provides features that enable contractors to monitor subtime, their performance, and their status. And we'll take a little look at that later. Unanet has more information on generating the ICE schedules, in particular this process that I'm mentioning and how you use Unanet data to generate the schedules in what we call a Knowledge Center entry, and we will make that link available to you, a Knowledge Center entry that describes the process, and also a webinar, a previous webinar that Asa mentioned on this process, and we'll provide that link for you as well. So let's take a look at a few of the reports that help simplify the preparation of your incurred cost schedules. So the first one I will mention is the project cost summary. This is kind of the go-to report for organizations, for GovCons using Unanet, both in the contracts area, the finance area, project management area, and it allows them to view a real-time status on a project or task's total direct and indirect costs, along with revenue and other KPIs in real time, and that's the key, or based on posted data. So this report can be run for all posted actual data for the reportable year in the ICE workbook using provisional rates and using actual rates to calculate indirect costs. So throughout the year, the PMs can monitor the status of all costs at any time, including subcontractors' costs, which could be coming in real time just as employee costs are when your subs are reporting time in your system. And the added benefit is the ability to bundle actual costs and revenue to date with estimated costs and revenue based on a defined forecast or budget for a comprehensive 360-degree view of a job, which enables PMs to shift gears, make adjustments to resources or estimates, and to ensure that the project remains on track and on budget. So that's a really key report. Another one is the project summary by cost element. So this particular report provides data to populate Schedule H, and it is a key piece of this ICE process that Unanet has developed that you'll see in the Knowledge Center link and in the webinar. So customers use this report to generate basically a separate tab in the ICE workbook, which facilitates populating Schedule H. And as you know, Schedule H, it can be complicated and time-consuming to prepare. Another report that I'll share with you, again, part of this process to generate the ICE schedules, is a Unanet ad hoc report for time and materials contracts. So we provide a raft of reports for all contract types, and this one in particular is an ad hoc report that we've built specifically to facilitate completing Schedule K for T&M contracts. This is a sample of the report, which requires a summary of hours by labor category and the extended billable dollars for each funding level. The ICE process does create a new tab in the ICE workbook for this report, and data is referenced into Schedule K or copied directly. So Asa, along with the Unanet's General Ledger summary or trial balance report, which of course provides the financial data in the other schedules, those are just a few of the key reports in Unanet that help make the ICE prep much easier. Awesome. So with that, so with that, we have poll number 2. So let's just get a sense of what kinds of contracts you all have. Again, help us to guide this conversation as we proceed. So if you would go ahead and respond to this poll, we'll start watching the results. A lot of you, a lot of fixed price contracts, a lot of T&M, actually fairly evenly distributed across the 3 contract types. Okay, we'll go ahead and shut the poll and share the poll results, and there you go. So of all of you on the webinar, 87% have fixed price, 81% T&M, 76 cost plus. So a good representation, Asa.
Good deal. Yeah, that's interesting. That's generally what we see at most contractors that are working in the federal government. They kind of have a mixture of contract types.
Okay, and that's over to you.
So if you are one of those contractors that has a mixture of contract types, one of the first questions you may have is, how do I know what to do with this contract in terms of the incurred cost submission? And there's really only one reason I would ever prepare an incurred cost submission, and that's because it's contractually required. So when you go to the end of your contract, you have all these FAR 52 or DFARS clauses that are there, other agency clauses. But the one you're looking for is called the allowable cost and payment clause, and it's FAR 52-216-7. And this clause, it goes into a lot of detail about invoicing and submission. It's one of the longer contract clauses in Part 52. But in the middle of the section at item D, it says the contractor shall submit an adequate final indirect cost rate proposal. And anytime you see anything in the FAR where it says shall, that's non-negotiable. You've got to do this. And so, that's what you're really looking for. That clause, it goes on. There's a lot of other information there. It tells you that the submission is due 6 months after your fiscal year end. So if you're 12/31, you're looking at getting your submission in by June 30th. It talks about extensions, and I can tell you from experience, when they say only in exceptional circumstances, they really mean it. Don't count on an extension for your incurred costs. And then finally, they reference adequacy and adequate. It goes on to explain, kind of what the required schedules are and what they mean by adequacy, but it doesn't go into a lot of detail. But DCAA has provided us with an adequacy checklist, very helpful there, and we're going to talk about that in some of our later slides. So next slide there. So if you're doing anything with the government, you always know that there's always a but. So the but in this case is that 52-216-7, the allowable cost payment clause, is what you're looking for. But there's another clause that may intersect, and this clause, the T&M payment clause, 52-232-7, applies to time and material contracts, as it sounds. And these contracts, they're really hybrids. You have T rates that are fixed at contract award. So your labor rates using the bill on the contract for your labor hours, those are fixed. They don't true up, or they're not negotiable once the contract's awarded. But then on the other side, you have your M components, and materials covers things like travel, ODCs, and basically all your non-labor costs. And those costs, they're billed on a cost reimbursable basis. And you're likely burdening those with G&A or maybe material handling, depending on your rate structure. And that G&A rate and that material handling rate, that is flexible. And so you're billing at provisionals, and you have to true that up. So the two types of contracts that we're most focused on are those time and material contracts and the cost type contracts. And those are the only two that really have a contractual requirement typically. There's some exceptions here and there that we'll talk about a little bit later. So, all right, next slide. So as I said, in practice, these are the only types of contracts that would require an ICS. But to present these contracts, you have to show all the costs of the company. So that means showing some costs related to your fixed price contracts or your commercial contracts and some other ways. But by showing that contract cost, we're only really showing it at a summary level for any contract type that's not cost type or T&M. And for our pools, where we present those on schedules A through E, we have to show financial data, as Donna mentioned, that links back to your trial balance. And in practice, we often see DCAA impart ICS requirements into other contract types, like federal supply schedules, AMCOM Express as an example, maybe fixed price or level of effort type contracts. And when you get that type of pressure, it's always important to go back to the contract to determine what your individual requirement is. Sometimes in practice, it's easier just to kind of deal with presenting the information, even though it may not be contractually required. But I always encourage you, your contract is your customer. That determines what you have to do, and so when you're trying to decide, look for these clauses that we referenced, the T&M payment clause and the allowable cost and payment clause, and that tells you really whether that submission requires that contract to be disclosed in detail. So when it comes to contracts themselves, we show that on Schedule H, and that's where we present that project level detail that Donna spoke about in some of the earlier slides from Unanet. In terms of importance, Schedule H is right behind Schedule I as far as importance in the ICS. And Schedule H is kind of like a giant project cost summary or job status report. And those kind of standard reports out of Unanet make populating Schedule H much easier. So Donna, would you mind showing the JSR and just a little bit about what that report offers?
Sure. Thank you, Asa. I like your comment about your contract is your customer, and that's a perfect segue into this. So this is a basically job summary report. JSR, as it's commonly referred to, or project cost report. This comes in a number of different flavors in Unanet. This is one of them. I had a different flavor, more of a horizontal view earlier in this presentation. But this is a key report that provides the costs that you need for the schedule. So with Unanet, this report is available as a standard report and very similar to data required on Schedule H. The JSR, along with its sister report that we saw earlier in the webinar, the project summary by cost element, facilitate the completion of Schedule H. So the JSR, many of you are familiar with this, JSR shows a summary of costs by cost element for any period of time and can be run by project and by task or CLIN or SLIN, again, within your project. So you can look at the level of the funding level to get this information. And similar to some of the other cost reports, the JSR may be run using provisional rates that were used for billing or actual indirect rates that were calculated by the system on a monthly basis. So differences in allocated indirect costs based on provisional and actual rates can be clearly seen. So the JSR is a configurable report in terms of the row data displayed, and the drill down is available on labor and expenses also, which is a handy feature. And finally, as we saw earlier, the format is available in a periodic presentation where actuals are represented through a given date and plans or budgets through the end of the reporting period, which provides, again, a more comprehensive view. But this is a key report that outlines costs and revenue, but certainly costs at the cost element level and for a period, over a period of time for your job. So Asa, the trio of reports, the JSR, the periodic cost summary and status, and the project cost summary by cost element provide the tools for PMs to manage projects and finance to generate the necessary project-related ICE schedules. The ad hoc report also contributes to that presentation. And again, these reports are pulled into the workbook, and data is literally copied or referenced from these reports in order to simplify the preparation of the schedule. So we've been talking a lot about incurred costs, so we want to get your sense of how you feel about incurred cost submissions. So give us a sense of how you feel about them today, and go ahead and complete the survey. So as expected, we're getting some interesting results. No, I'm surprised everybody doesn't love the incurred cost. So it looks like with about 60–70% of you, well, let's wait till we get about 85% voting. Okay, I think we're about there. So 53% of you find it to be a tedious exercise, not a surprising answer. We'll have to help some of you who find it terrifying. And 5 of you think it's one of your favorite things, so that's terrific. Hopefully this will make it even more of your favorite activity. And then a lot of you just really want to know more about it. So thank you for responding to that poll. Okay, Asa.
Yeah, for the record, my answer was not tremendous. So, the next slide here, we're talking about the adequacy checklist. And as I mentioned, the adequacy checklist, it's about 7 or 8 pages long. There's a lot of detail in there. So we're just going to kind of go through a top 3. But DCA does make a lot of information available at their website. So I wanted to point you in this direction. There's a link there where you can download it. You can also download the ICE model itself, and it's got a little instruction manual that comes along with it too. But before we do get into that, I wanted to point out kind of where we're at in the process. So typically, once your submission is turned in 6 months after your fiscal year end, you may not hear from DCA for a while or even at all. But DCAA does the adequacy determination generally about 3 to 6 months after the submission. At least that's kind of the timeline we're seeing of late. A few years ago, you might hear from DCAA about adequacy 3 to 6 years after submission, but they're kind of getting caught up on their incurred cost submission, so we're starting to see this adequacy process take place much earlier. So in this case, if you get no news, it's generally good news, because if your submission is deemed adequate, you don't get a gold star report or really any notification. But if your submission is deemed inadequate, you'll get a letter from DCAA, and they typically copy your ACO, and they indicate the inadequacies. And if you've gotten one of these letters in the past, or if you get one this year, I'd say it's not a huge cause for concern. It's something you want to address, but recognize that there's a lot of these that go out. The ACOs, they pretty much just, it passes their desk for the most part. So if it's your first one, address it, make the inadequacy request that they've asked you for, and move on with your life. If it's the second, third, fourth iteration of inadequacy letters, then it's a little bit more cause for concern, but it's just a normal part of the process. So the takeaway here is that the checklist is publicly available, so use it. Internally, we prepare an adequacy checklist that's customized. We've tailored it a bit over the years, but it's ultimately based on DCAA's checklist, and we do that for every submission that we prepare or review before it goes out the door. So on the next slide, we're going to transition into some specific areas of adequacy and kind of go through that top 3. So the first here, it pertains to Schedule H, and there's probably 4 or 5 steps in the adequacy checklist that we're going to address as we go through this, but I just kind of wanted to bundle them together. But the biggest thing that we see is failure to reconcile cost pools and the trial balance to Schedule H. And follow closely by that, failure to include some other required data on this, grouping your contracts by agency, showing the contract number, et cetera. So as I mentioned before, Schedule H is a bit like a detailed presentation of your project ledger, and Unanet makes this a lot easier. But with this schedule, the story we're trying to tell is that we have claimed all of our allowable costs. So the first few columns you're looking at there on the left, those are your direct costs, and those should reconcile right back to our general ledger or to our trial balance direct cost accounts. And then in the columns to the right, we allocate our actual indirect costs we've calculated within the submission. And in those columns, they should reconcile back to the schedules where we presented those costs. So for overheads, you go to Schedule C, and for G&A, it'd be Schedule B. And your Schedule H may look totally different than this one. You may have, a dozen different indirect rates you're applying, or a bunch of different kinds of direct costs. But ultimately, we're showing the same thing. We're showing direct costs, and we're showing our indirect costs, and we've got to be able to reconcile those. And then ultimately, over on the far right, the grand total there, that should represent total costs claimed within the submission, but it should also reconcile to the sum of your total direct costs plus indirect costs, less any unallowable costs. And that's a quick check to make sure that you've actually picked up all the costs and claimed it within the submission. So you'll see, down at the bottom there, there's some rows, and they're kind of hard to see. I know, I apologize, but basically when we do a submission, we go through and we do these reconciliations. So for each of our direct cost elements there, we're tying that out back to the trial balance, and then over on our overhead column, we're tying that back to Schedule C. Our G&A base, we can reconcile back to Schedule E, and then for our total G&A applied, we can reconcile that back to Schedule B. And you'll notice there's some variances there, and this is straight from the ICE model that DCAA gives. And one thing I'll tell you is if you're using that ICE model, it's probably not going to tie out to the penny because they use the round function pretty liberally throughout the submission. And that function will cause some rounding errors. And so I wipe those round functions out as the first thing that I do when I get a new incurred cost submission, just because I like for things to tie out. It gives me some reassurance that things are presented accurately. So one other important point to note, and it's not necessarily an adequacy issue, but it is something that'll save you some time. Remember that you only have to show contract detail for the cost type and T&M contracts. So you'll see fixed price and commercial. They're kind of rolled up into a summary line. So there may be 50 contracts presented in commercial, but you only show the grand total, and you really only want to show the grand total. Now, if you break it all out and you show them contract detail for your fixed price contracts, DCAA is not going to say no, but it's giving them more information than they really need to see, and it's not something I would recommend. And the last point here is to make sure you group your contracts by agency and include all the required information. So those columns there to the left where we have job order and prime contract number and subcontract number, those are important. If something's not applicable, put an NA. DCAA likes to get pretty ticky about this. particularly when it comes to agency, because that's how one of their first steps in the risk determination process. So they need to know what contracts they're responsible for, i.e. the DoD contracts. So if you have non-DoD contracts like NASA or DOE or any other agency out there, it can lower your risk from a DCA perspective unless DCA has been engaged by those other agencies to audit those contracts as part of your submission. So, and then last point, just remember, if something doesn't apply, put an NA and maybe include an explanatory note, and that goes really for all schedules. So that's Schedule H. So the second one here, this is Schedule I, and these two schedules combined are the most important schedules in your submission, but there's a lot of things that flow and interact with it in this giant Excel spreadsheet, and a lot of the information on Schedule I comes in automatically from Schedule H or from Schedule K, so it's pretty easy to kind of overlook because most of it gets populated on its own. But the first thing I wanted to point out here is that there's several yes or no questions you have to answer, and you'd be amazed at how many submissions we see where somebody just forgot to tick a mark, and usually they only kick them back for adequacy if there's other things going on when it comes to this, but it's something that's easy to overlook. So the first one is whether the contract is subject to penalties, and that's there in that column there on the left. It's got a note 2 underneath of it. So penalties clause comes into play. It's typically only going to be on your cost type and T&M contracts that are in excess of $750,000. But if you want to go look for your contract, it's FAR 242-3. That's the penalties clause, and FAR Part 42.709 covers some of the more detail around the penalties that are applied. But just know, if you include unallowable costs, you're signing a certificate with this submission saying that you have not included unallowable costs. And if they're there is the potential for penalties, and they can get pretty steep. They're dollar for dollar. But this is where you tell DCA if your contract is subject to penalties. The other yes/no is over on the far right where it says physically complete, and that's basically just asking if the contract is ready to close. And the kind of interesting thing here is that there's a link between this column and Schedule O, but it's not a physical link. It's not, there's not an actual link in Excel to do it. But what they do is they're looking for contracts here where you said yes, ready to close, and then they go to Schedule O, which is the contract closing schedule, to make sure that you presented those contracts there. So if you have 3 yeses on Schedule I, you should have 3 contracts listed on Schedule O, and that's the connection there. And one point, this is again from the ICE demo. This is DCA's own ICE model, and you'll see for the several in both columns they don't have a yes or a no. And in the last month, I've seen inadequacy letters for this very issue. So the takeaway here is, I guess, do as they say, not as they do. And one other quick point here on Schedule I that I see a lot of issues with is where we're looking at the cumulative build amount there. You can see where there's kind of over to the right, there's totals there. Really what we want to do is we want to match this cumulative build amount to our cumulative cost incurred. And it's important to note that that's not necessarily, and in most cases it's not your December invoice. A lot of people think I just show my last invoice of the year here. That's not what you want to do. Likely your December costs weren't billed until January, February, or maybe some point out in the future. So you may have to go further out than fiscal year end, and that's something I see a lot of people kind of trip up on. And then finally, your cumulative costs are there on the left, and these cumulative totals are from contract inception to date, so that you're doing the incurred cost submission. And it's critically important that you get these costs accurate and that they tie from year to year. The ICE is a living document, so if we did one in 2014, some of that data would likely show up in 15, and then so on and so forth. And the reason it's so important is because this is the schedule that DCMA or your contracting officer, whatever agency you're working with, is going to use to close out your contract. So if you get off course and for some reason, costs don't get pulled over properly from the year prior, you may get to a point where at contract closeout, you've got a slightly different cumulative allowable cost number than what your customer has. And that can be very problematic. We've got an issue right now where DCAA did essentially final indirect rate agreements. They didn't do an audit. They just issued final rate agreements on a number of years. And now we're heading to closeout, and come to find out the contractor had put in some wrong amounts there. And when we go to DCAA and say, hey, your cumulative allowable cost worksheet or Schedule I is not accurate, here's the right numbers, their response is, we've done a final indirect rate agreement, we don't want to talk about it. And vice versa on the contracting officer side, they pass the buck back to DCAA, so we're kind of stuck in this infinite loop. And it's something that could have been fixed with just a good prior review of the submission before it went in, making sure that the year's tied from year to year. All right. So the last one here, Schedule J and Schedule L issues. We see a lot of these, and it's because they're more of what I would call supporting schedules. We're not calculating rates here or presenting contract costs. We're really just pulling information together for DCAA to further evaluate. So Schedule J there along the bottom, and that's just one snippet off of Schedule J. We break out our subcontracts into various categories for them to take a look at, and the total cost incurred in the fiscal year should agree back to Schedule H. So if we sum all of our cost incurred there in FY 2009, that should agree back to our total subcontract costs claimed on Schedule H. And the issues that we see here really stem more from qualitative, leaving things blank again, not including addresses, etc. And the reason DCAA spends so much time beating the schedule up is because it's again, another big step in their risk assessment process. So if you have subcontracts that are issued under flexibly priced contracts, so your cost type and T&Ms, those subcontracts may also be subject to audit. Or they may have already been audited by DCAA in another region or another branch. And so they want to know what your subcontract costs are because it determines how much testing they're going to do in that area. And so the leaving off an address or contract value may not seem like a big deal, but they do, kind of beat this up a lot. And the other key takeaway here is that it may lower your risk of the submission. So if you've closed some of these contracts, it's important to let them know that they're closed or if they've already been audited, just to continue to lower your risk as much as possible. So Schedule L over in the upper right corner, that's basically just a reconciliation of your total labor costs that you've reported within the submission back to your 941s that you submitted to DOL. And this is DCAA's attempt at what I would call third-party audit evidence. But most of the problems that we see here is if you use the ICE model, there's a formula that will supposedly, or macro, that will supposedly pick up all the labor off of your other schedules. And it's about as reliable as a wet paper bag. It doesn't work. So you really want to hard key this back, otherwise you're probably going to see some variances here. And then the recon down at the bottom, there was kind of an unwritten rule up until the last year that if you had a variance between your total cost in the submission and your 941s, as long as it was within plus or minus 2% of the total payroll, DCAA would generally pass on any further work. They wouldn't ask too many questions. But just recently, in the last 6 months, I would say, we've had several audits where auditors spent an incredible amount of time beating up Schedule L. And I don't really know at this point if it was isolated incidents. Both the auditors that we're dealing with, they were fairly new to DCAA, but it may be part of a wider trend. But just the takeaway here is that you may want to spend a little more time on Schedule L this year as a result. And as I said, it's pretty rare for the schedule to tie out perfectly at everybody but the smallest contractor. So some variance is expected, but spend as much time as you need here to get as close as possible. So I think we have a polling question coming up next, Donna.
We do. The next question, to get a sense of where you stand, how many years of open incurred cost submissions do you have in your organization? So if we could just go ahead and respond to that. So we've got about 30% of you have voted. Let's wait another few seconds here to get a few more results. They're coming in. We're at about 60%. Wait till about 80, get a sense. Okay, I think we're at about 70%. Let's go ahead and close the poll. So we've got, again, kind of an even distribution here. So Asa, we have 26% of the folks who responded have 0 years of open incurred costs, 28% between 1 and 2 years, 26% between 3 and 5, and then a fairly sizable portion, 19% of greater than 5 years of open incurred costs.
Very interesting.
Yeah.
So if we would have done that poll probably 3 years ago, I think the number of submissions that had over 5 years, or contractors that had over 5 years of submissions, would have been much higher. So this chart that we're looking at right now, this is kind of a little look under the hood of the DCAA. The data that's represented here is pulled from their annual report to Congress, and the reason I want to show this to you is to understand what's going on behind the scenes so you can accurately predict your chances for being selected for audit. So we've transitioned out of the adequacy phase, and now we're talking about how do you actually get selected for audit. And a little history going back in time, starting in 2009, 2010 time frame, DCA had some issues come up with their peer review. So they're peer reviewed just like your public accountants are that are doing attestation engagements. And GAO does the peer review for DCAA. And they, as a result of that peer review, DCA lost their ability to issue audit opinions for quite a long time, a couple of 2 or 3 years. So as you can imagine, they can't issue audit opinions. Their sole function in life is to perform audits. It created a little bit of a backlog. So when you're looking at this, you can see this on the line labeled Incurred Cost Audits or INC cost audits, and then in parentheses there's a backlog number. So in 2009 there were roughly 7,800 incurred cost submissions sitting out there, and then we fast forward 2011, 2012. You can see the number of submissions coming in. Like in 2012 we had 1,795, and then the backlog just continued to grow, 4,088. So all the way up to 2015. The number of submissions seems to be tailing off a little bit as the government pushes more towards fixed price vehicles and some of the other vehicles that don't require incurred cost submission, but that backlog number keeps growing. So what we're expecting to see, because of what they've been doing called low risk audit determination, we're expecting to see in 2016 when they do their report to Congress that backlog number will basically have evaporated. So what's been happening behind the scenes over the last year is that DCA is doing a lot of what they call low-risk audits, which aren't even audits at all. Basically, they take the submission and they may make a kind of a subjective disallowance for past unallowable costs that have been in your submissions that have been audited, but essentially they're just agreeing on the rates via a rate letter if you're low risk. So the question that you probably want to know is, how do I get to be low risk? But as a contractor, this is a good thing. The ICE process is going much more efficient, but as a taxpayer, I don't really know how I feel about this because having worked with a lot of contractors over the years, there's some that absolutely need to be audited. But the reality is we're moving through this process much quicker than we ever have before. So on the next slide, this is their low-risk process, I guess. And just fair warning, this table may not be 100% accurate. This was published back in 2012 when they originally introduced this low-risk process, and since that point in time, they've communicated some about it via their MRDs, but the actual methodology is on the DCA intranet, so it's kind of behind the firewall. So we don't know exactly what it is right now. I've got some guesses, but the general approach is that if you're over 250, you're always going to get audited. So these are the big guys. And when we say ADV, that's auditable dollar value. So remember on the incurred cost submission, cost type and T&M is what we're worried about. So if you have $100 million in total cost on Schedule H and $50 million of cost type and T&M contracts, your ADV would be that $50 million number. So if you're over 250, you're going to get audited. If you're between 100 and 250, you're most likely going to get audited every 3 years. But when you fall below that 100 million mark, which is a lot of contractors out there, and you qualify as low risk, which means you haven't had any significant amounts of question costs in prior years, haven't had a lot of unallowable costs on your submissions, you basically get a lottery ticket into the low risk pool, and they do a random sample selection. And that selection has varied year to year. In the last 2 or 3 years, they were doing it on a region level. They appear to be doing it nationally now, so headquarters is actually doing the sample selection. But the general takeaway here is, regardless of how they're doing the selection, is that the lower your ADV and the cleaner your submission is, then the more likely you are to not have an audit, which is a good thing for you guys. So passing note that, as I mentioned, this chart's not 100% accurate. They're not publishing this. It's not out there publicly available. But in August of 16, they revised it a little further through an MRD. And they basically, what we think they've done is they've extended that bottom boundary. So it used to be less than 1 million with 0%. They're now selecting some very small portion of contractors in the 1 to 5 million range. So we've had some that got selected for audit that had less than $1 million of auditable dollar volume. But that's the general process they're going through. And the other thing I would say is realize that this may not be a continuing trend. The reason they're doing this is to get rid of that backlog. But eventually when that backlog is gone, they're going to have a lot of auditors twiddling their thumbs. And so a lot of the process of determining low risk is kind of subjective. So we're expecting to see them, once they get caught up, maybe reverse course a little bit and start doing more audits, at these lower boundaries. The other thing that's going on right now is if you're following the 2017 NDAA, there's some proposals in there to basically eliminate DCAA's role at non-CAS covered contractors. So if this passes, cognizance for those contractors, which would be anybody that's not subject to cost accounting standards, would pass to the public sector, meaning that the role DCAA now plays doing ICE audits and all these other fun things, proposal audits, would be filled by public accounting firms. We've already seen this with non-DOD agencies, NASA, DOE, and others. They're outsourcing their audit services. But it remains to be seen if DOD, the agency with the largest audit volume, will also follow suit. So I think we have one more poll question coming up, Donna?
We do. So we want to get a sense of when did all of you last have a visit from a DCA auditor? And go ahead and vote or cast your vote. And we'll take a look at what your experiences have been. So we got about 50% of you voting. Okay, let's see. We'll wait another second or two. Okay. Okay, so we got about 3/4 of you voting. So, okay, so here are the results. Regular contact, 18%. So a lot of you are in constant contact with DCA. Less than a year, 1/4 of you that have voted. 1 to 3, 31%, and more than 3, 25% of you had your last visit from a DCA auditor. So there you go, Asa.
Awesome. Yeah, and that's typical. I mean, within our client base, we see, it kind of runs the gamut. We have some larger ones that have resident auditors, so they basically live in their facilities and they're there 24/7. And then, for some of the mid-size, they see them on a recurring basis. And then, some of our smaller contractors, it may be a year or two, between visits. But they are out there and they are more active. And I think with this low-risk determination process kind of coming to an end and clearing the backlog, if anything, we're going to start seeing DCA be more active. So they may be doing defective pricing audits or business systems audits, staying more current with those things now that they don't have this, kind of elephant in the room of 11, 12,000 submissions hanging out there waiting to be audited. So making the transition from the audit process, low-risk determination, into some current events, I did want to make you aware that there's a new ICE model out there. They went from 2.01E to 2.01F. And the good news is that there was no real change other than this one little thing on Supplemental C. But this little change is also kind of important. It seems like a very benign sort of question. You have this question here that says, release subcontractor data to the prime, yes or no? And historically, when DCA would come in and do an audit, basically for anything other than a proposal audit, if the prime needed to be linked in some way, so you've got a subcontract that the prime needs to close out, they may need to know what your final rates are. So they would send you a letter and say, hey, do you consent to release of your submission, your audit report to your prime contractors? And I would always tell clients, no, don't ever say yes, don't ever release that, because we, as the contractor, we want to control the release of that information. So your audit report from DCAA on your ICE audit, it has all kinds of data in there. I mean, with contracts that are not germane to your prime contractor. So they may need to know your final G&A rate so that you can true up your T&M, but they don't need to see your overhead and other rates. So you want to control that. So pay particular attention to this. My advice would be to answer no every time to every question, so that you at least get prompted and asked by your prime or asked by DCA, and you can control that release of data. So big, minor change, but it's a relatively important one. So pay attention to that there. So the next slide here. So another current event that's going on is this whole recurring theme of subcontract monitoring and question costs as a result. And we're seeing this, in voucher audits, voucher examinations, incurred cost audits, CPSR reviews, a lot of different areas. The DCA and DCMA both are beating up this, prime responsibility for managing their subcontractors. So this case, the LMIS case, there's an ASBCA reference number. You can go out and pull it down from their website if you want to read it. And I read a lot of case law, and I'm a nerd like that, but this case ranks probably on one of my top 10, for entertainment factor. But in brief, DCA and the government attorneys, they latched onto a sentence in FAR Part 42 that very simply says the prime contractor should manage his subcontractors. That's it. Doesn't go any further. Manage your subcontractors. But they took that and they expounded on it and kind of created their own version of the regulation to create some additional duties that they felt like the prime contractor should be doing. And thankfully, the board agreed with them that those were not contractual obligations. Some of the things that they said that, they questioned these costs because the prime required or failed to require their subcontractor to submit an incurred cost submission. It's interesting how, another company could compel the submission of an incurred cost submission, but that DCA felt like that's what they should be doing. They also, beat them up because they weren't creating slowdown clauses that allowed the government or prime access to the subcontractor records. And the important point to note here is that the government wants a firewall between the prime and the sub in most cases, because that, prevents them from having to get involved with all kinds of fun, contractual matters that they don't want to be a part of. The government contracts with the prime contractor. The prime contractor has preview contract with the subcontractor. The prime is responsible for that sub. But in this case, DCAA and government attorneys, they went along with them, seem to be thinking that that the primes need to be doing more. But the board, thankfully, disagreed. So what we want to know is, what should you be doing? And that's what we're going to talk about in the next slide. So some of the takeaways from the illness case were things that they were doing to monitor subcontracts that the board felt were adequate. So this case, it dealt with a T&M contract, so much of their monitoring being performed and seen as appropriate by the board centered around this type of contract. So it's, with case law, you can't just, take one-to-one and say, okay, I did this, so I'm all right. But it is a good, kind of general guide. So one of the first things that they keyed on was the need to validate subcontractors' accounting systems, and this company was doing that. They had some mechanism, be it a checklist or a certification of some sort, that required their subs to have an adequate accounting system, or they were using their own internal timekeeping system. And that's something that Donna talked about earlier about how you can potentially have your subs directly linked into your Unanet system to be able to get that sub data on a real-time basis. The second point there is the need to monitor your subcontractors' billing and progress through ETCs, limitation of costs, funds notifications, as well as monitoring the personnel assigned to the labor categories to make sure that they qualify, they have the required experience, they have the required education, etc. So Donna, I know Unanet has a lot of good features in this area that can make the prime contractor's life a little easier. And I believe I've seen a few instances. I know we have some clients where they're tracking sub costs and time at near real time because they're entering data into the Unanet system. Can you maybe share a little bit of insight on that?
Sure, that's right, Asa. You're absolutely right. So Unanet has quite a few features to manage subcontractors that make it very simple for both the prime and the sub. So a couple of them I'll point out. With Unanet, a GovCon can budget and plan their subcontractors on projects along with their employees, so they can not only see and track actual costs, but they can actually predict and plan out and budget for their subcontractor costs down to the actual sub-company and sub-employee if you want to get to that level. On top of that, of course, as Asa said, subcontractors can be embedded right into Unanet with the employees so that subcontractors can report their time, they can report their expenses directly in the prime's Unanet system so that they'll have, the prime will have immediate on-demand project status reporting, and the costs for those subs will be immediately available in real time, just as they are for their employees. Moreover, most of those Unanet customers approve sub-timesheets and use the approved time and expense and the rates associated with those labor categories for the subs to generate a payment to those subs without waiting or ever receiving an invoice from the sub. So there's no delay in payment, no delay in invoicing the government, and no lag in reporting for the prime. So the sub costs are known as they are incurred. So this works well for everyone, frankly. In addition, there's a lot of other types of data about subcontractors that a prime needs to store and have readily available. And one of the other features in Unanet that facilitates that is a collaboration workspace that we call Project Notes, where key documents, actions, notes, performance, information on subs all are housed in an area workspace called Project Notes. And Unanet customers can store their subcontractor agreements, their subcontractor skill sets, certifications, past performance, and all of that is available and easily accessible for when you're generating proposals as well. So really along the entire spectrum, from planning and budgeting all the way through time and expense entry, and then payment actually invoicing payment processes to facilitate subcontractor management. So those are some of the features that Unanet provides.
All right, thanks, Donna. So the last bullet there, consent to subcontract, that stems from FAR 52-244-2, which requires the contracting officer to grant consent to subcontract prior to you engaging a subcontractor, unless you have an approved purchasing system. And this has become a very big deal of late. And it's not really something you want to skirt. Again, things kind of come in cycles when you're dealing with the government. There's a tremendous amount of clauses, and what they choose to enforce, kind of varies from time to time. And but this is an area right now, consent to subcontract, that's becoming a very big deal. And I would, encourage you, as your contract requires, ask for consent every time if you don't have an approved purchasing system, and you'll know if you have an approved purchasing system. But you need to do that whether you present that sub in your proposal or even if it's called out in the contract. You need to ask for consent to subcontract. It's easier to just send a simple email or a written letter requesting that consent than it is to try to deal with any of the fallout downstream. And in the next slide, we're going to talk about some of that fallout, what it can mean. So this is another Board of Contract Appeals case, Technology Systems. And it dealt with a lot of different areas of costs. They made some very interesting commentary on professional fees and some other things. And I'm going to give a shameless plug here for Mike Steen. He's our lead technical director, and he's a former Eastern Region director from DCAA. But he leads the authorship of our monthly newsletter. It goes out to 5,000 or so GovCon subscribers. But he wrote a really excellent article on this particular case, and it goes into a lot of those other areas of cost that the board touched on as part of this case. And if you don't receive it already, you can go out to our website. It's just redstonegci.com and sign up for the newsletter, and it comes in on a monthly basis. We don't spam or any of that fun stuff, but it is a lot of good information there. But what happened with this tech systems case is that they did not seek consent, and after the fact, they went back to their contracting officer, technical representative, and they had an affidavit from him or her basically saying that they had performed, the sub had performed on the contract, they'd done what they needed to do, but the board latched onto the fact that even if the performance was rendered, they did not determine whether the cost was fair and reasonable at the outset of the contract. So they didn't do any cost analysis, they didn't do any price analysis. So it's kind of a two-pronged thing here. You got to get the consent, but you've also, in order to get consent, you've got to show the government that the price that the sub is proposing is fair and reasonable. And again, we're seeing DCA ask for this as part of routine voucher examinations. They're definitely doing it as part of incurred cost audits. So even if you don't have a CPSR, it's still critically important that you seek out some guidance on implementing at least portions of the CPSR criteria related to the cost price analysis, negotiation, and some of these other areas that intersect with cost allowability. By having these policies in place and the practices operating that way, you really insulate yourself from what can be a lot of costs. In this case, they basically questioned the entirety of this contractor's subcontract costs, and the board agreed with them. Now, it'll likely be appealed. There's some old case law out there basically saying the government can't receive something for nothing, so they'll ultimately settle likely, for some reduced amount of that they'll get, but they're definitely not going to make any money on this subcontract cost that was associated with this case. So, and the CPSR in general is probably the most popular area right now as far as our consulting services. We're getting a lot of requests in that area, and it stems from things like this, but it also stems from the fact that a lot of government agencies are putting a lot of emphasis on the purchasing system. So if you've heard of OASIS and some of these other large contract vehicles, there's a lot of points that can be awarded for having an approved purchasing system. So we're getting a lot of interest here. So if you are not familiar with the purchasing system area, I know it's outside of the accounting system, go take a look at FAR Part 44, and if you need any help in that area, that's definitely something we can assist with. So, all right, next slide. So the last point here, and we're going to wrap up, is executive compensation. Executive comp has been an issue for as long as I've been doing government contract consulting, but it got a lot more thorny back in 2014. So up until that point, we had a max ceiling on comp, and it was just shy of $1 million. And I guess Congress decided that they didn't want to break $1 million in allowable comp. And so as part of the Bipartisan Budget Act, they kind of reset the clock, and they reset it back to $487,000. So the effective date of this new rule was June 24, 2014, and for most contractors that are on a December 31 fiscal year, it kind of splits the fiscal year. So contracts prior to June 24, they're subject to the old ceiling, so 900 and something thousand. Contracts awarded after June 24, 2014 are subject to the new ceiling. So you have this unique occurrence within the incurred cost submission where you've got potentially contracts subject to different amounts of disallowance. So you can handle this in a couple of different ways. You can calculate 2 G&A rates. You can do a blended calculation. But either way, if you have this issue, if you have highly comped people, you need some sort of advanced agreement with your ACO on how you're going to handle it. And we've done a lot of these over the last few years, but it does take a lot of time for approval. Hopefully, if you have this issue, you've already addressed that. What I wanted to talk about today is that to add even further complication is that we're expecting to see this cap nudged up again. It's indexed, supposed to be indexed to the Bureau of Labor Statistics data. So it's at 487,000 as of June 24, 2014. We should have seen an escalation in 15, and we should see one in 16. So we're expecting sometime in the next couple of months, probably about a month out from when you're going to turn in your incurred cost submission, we'll see some new caps come into play. And now we're going to have the same issue. So we're going to have comp ceilings that potentially 3 or 4 that we're going to have to wait into this blended calculation. I hope that they, dispense with the period, this partial year period, and just say the new ceilings they're subject to FY15 and FY16, make it fiscal year total instead of being a mid-year kind of break. But just be advised, the government doesn't ever like to make things easy, and that's kind of floating around out there. So if you don't have anyone over the compensation cap, you don't really have to worry about this. Yours will just be your compensation, but you do still have to contend with DCA's test for reasonableness. And if you have salary, I would say if you're north of 200K, anybody that has salary north of 200K, they're at risk. If you're north of 300K, that's when you become kind of real high risk. And basically what they'll do is if they come in and they feel like, and again, the key word is feel, if the auditor feels like there's some risk with the compensation you're proposing for your executives, the auditor doesn't do the testing. They actually submit the data surrounding it that comes out of the incurred cost submission for that individual's compensation package, and it goes up to the Mid-Atlantic Compensation Review Board. And they have a bunch of certified compensation planners and what have you, various credentialed folks up there that go through and they benchmark you. They've got about 5 salary surveys that they use, and they benchmark it, and they pick the lowest of the 5, and then they take the median plus or minus 10%, and that's what they determine to be the reasonable range. There's a lot of problems with this methodology. There's been several cases that basically stated that their method of doing the comp testing was invalid, but it didn't change their approach. And so we spent a lot of time the last year doing compensation defense work, and we do a lot of that. But the takeaway for you guys is that if you don't have a compensation survey, a reputable one, I would recommend that you get one, because the problem with these surveys is that they don't work very good retroactively. So if DCA shows up 3 years from now, you're not going to necessarily be able to go back and get that data from 3 years ago, unless you did it real time as you turn in your submission. So if you don't have one, like I said, that's something else that we can help with. It's a pretty cost-effective process. It doesn't take much time to pull the survey data and do a little bit of write-up supporting the comp, and it can help you tremendously when you're dealing with DCA downstream as part of audits. So,
okay, great. That's it. And we were running over just a little bit, so I'd like to just wrap up. We mentioned these 2 items early in the presentation, but Unanet has a resource site called the Knowledge Center for all of you out there, and you're welcome to go take a look at it. But it's knowledgecenter.unanet.com, and it has a lot of great information, and particularly it has a quick topic on the ICE model. So feel free to go and check that out. And then lastly, I just want to mention again that I want to thank you again for attending today's webinar. I hope it gave you some additional insight into the incurred cost submission. I think, Asa, you did a great job. You shared so much wonderful information for our participants today. This is our contact information. Feel free to reach out to either one of us for additional information, clarification, and I want to thank you all for joining us today. Thank you, Asa.
Thanks for having me.
Thank you, everyone out there.